Okay, so hopefully we're good and you can see my screen. So again, today is a two-part session, personal and business owner related. I do really like encouraging questions. It's a little bit challenging because I don't know what we're going to be able to see questions on Facebook. So give it a try. This is really our first Facebook Live that we've done. And then on Zoom, as you all remember, you can ask questions at any time. So on the Q&A tool that's built into the Zoom functionality on the bottom of your screen, basically, instead of raising your hand, we're going to have you go ahead and just ask questions. And so as we get through section one, I'm going to pause. I'm going to go through, see if I have some questions that are relevant that I want to share with the rest of the group. Also, we're making some note of that. So if there's some specific issues that maybe pertain to you and it's not really appropriate for a full group setting, then we'll take that offline and share, follow up with you as we, in a few days to kind of cover what's on your mind. So everyone's on mute. You don't have the option to unmute yourself. This webinar is being recorded. So for whatever reason, if you had to get off, we will be posting this on our YouTube channel by the end of the week. So I hope you enjoy. Okay, so first, always disclosures. And the big one is Vance Wealth does not provide tax or legal advice. You should consult your tax advisor before making any decisions. And that's really important. So today we're going to cover some planning topics, but a good financial advisor as well as a good tax planner really believes in collaboration. So it's really working with the client, working with the tax professional, the financial advisor to make sure that personal tax planning really factors in the entire relationship. And so anything I talk about today specifically, if you think it pertains to you, make sure you're double checking with us, your financial advisor, if we happen to be your financial advisor, or your tax professional, or I guess the preference would be check with both. So right now we're going to go into some personal tax planning. And I first want to just share with you some of the changes. And unfortunately, we just have a draft right now. This is not a done deal. So I want to share just some of the major differences. Now, what's not on this screen is at the beginning of this whole process, there were some major initiatives that were set out by the Biden administration to make some pretty dramatic changes. And there was talk about lowering the estate tax exemption, right? What we'd sometimes refer to as the death tax, lowering it from an exemption of, a little bit over 12 million and cutting that in half. Doesn't seem like that's going to be part of the bill. There was also chatter about getting rid of the step up in basis. So when you inherit money or when you leave money to your children, many assets like appreciated real estate, things of that nature, appreciated stocks, get what's called a step up in basis. There was talk about eliminating that. That is not part of the bill that we're seeing. So those are two big ones that I know a lot of our clients expressed concerns that those were going to be part of this bill because it would really dramatically change their planning and also kind of that legacy. So those are two big ones that are off the table for now. We'll see if anything happens going into 2022, but for this bill, it seems to be scrapped. So then there's also some other pieces in here. So you can see on the screen here, kind of right down the middle, provisions in the original House draft. They were talking about raising the corporate tax rate up to 26.5%. That seems to be thrown out. Just below that, you can see there were discussions of raising long-term capital gains and dividend tax rates to 25% from the current 20% at the highest level. That seems to be thrown out or at least passed on. They were also talking about basically raising the top ordinary income tax bracket, which would have been taking the highest bracket from 37 to 39.6. Again, that's another item that doesn't look like it made the cut. So I know there's been a lot of fighting going on, right? This has been going on now for 6 months trying to get something passed. And, because the way that our Congress and Senate, or the House and Senate are very divided, that if you don't get cooperation from, let's say, all the Democrats, or you get any cooperation from the Republicans, then these bills have really stagnated. And we've all seen the headlines. There's been a couple more, what we would refer to as more moderate Democrats who are fighting some of these provisions. And so they're going through their negotiations, and it looks like we're going to have some changes. So I do want to share with you a few of them, but there's not as many as we would have thought. And if any of you have tuned into webinars that I've done over the past 6 or 7 months, we have spent a fair amount of time talking about tax changes We did one back in June that talked about all these proposals. And, I kind of made the point that, our tax policy is not really the problem right now. The biggest issue we're having is too much spending, in my humble opinion, right? So it looks like we're going to settle in on spending is going up, but not to the degree that we initially were thinking that it was going to, at least the size of those original bills. And then the tax policies kind of making changes on the margins, not this sweeping reform. And generally, I think that's a good thing, that there are some modest changes, but it's not huge sweeping reform. And so, because that makes planning really difficult when you have these big changes. And so what you're also seeing on here, there's one big pleasant surprise that looks like it's in this bill, which is definitely going to benefit a lot of our clients, definitely going to benefit a lot of what we would call high tax states, or the blue states. So California being one of them specifically. So if you recall, when Trump put together his tax reform bill, he eliminated or capped the ability to deduct state and local taxes, right? So that would be your state income taxes, local taxes, which for most of us, that's primarily our property tax bill. So that was capped at $10,000 for single filers, head of household filers, and for married filing jointly filers. And that was capped at $10,000. And so in this bill that looks like it's going to make its way through and probably get signed, is that they're discussing lifting this cap from $10,000 to $80,000. And so that really helps most Californians that are, living in a decent sized house, maybe with 10 to 15 to 20,000 of property taxes, make decent wages, maybe paying $30, $40, $50, $60,000 to the state of California in income taxes. And so this $80,000 really kind of encompasses a big benefit to the majority of taxpayers, again, in these higher tax states. So what's interesting about this is what's written right now is it looks like it's one of the pieces that it's going to be effective for 2021, so effective for this year, and that it'll actually only go to 2030, and then it'll revert back to this 10,000 in 2031. Now, this is still pretty early on in the process, so I can't say for certain if that's going to be what's going to end up, passing. I think by the attendance that we have today, I think people are just interested to see what's happening. So this is definitely one of interest to most of us, especially those that are paying a decent amount of state and local taxes. Another one in here that I'll mention, but it's not super relevant to most, probably not anyone on this call, but there is a surcharge. So a big part of the agenda was to put in place what we'd call like a wealth tax, right? So on the uber wealthy, the people that are making over $10 million or are billionaires, as to how do we assess them more taxation. So there is a surcharge in this bill that looks like it's going to charge an additional 5% federal tax on any income known as modified adjusted gross income on income above $10 million, and that you're going to be at an 8% surcharge if you're over $25 million. Well, that's a very, very small percentage of our population. There's not that many wage earners that make that on a consistent basis. This will likely impact people who are selling businesses, right? Maybe they have a one-time event where they sell for a healthy chunk of change. So so there is this surcharge that's going to put in place, which again, it's not going to impact the majority of Americans, but it will have some impact on the much higher earners. So that's a super high level. I don't want to spend much more time on this because we don't know yet. And so I'll definitely come back. We're not doing a December webinar, but I'll come back and share, this will likely be an early next year, share some of the changes that come, but these are some of the major differences that we're seeing. So what I do want to spend a little time on is just reminding people about how to save taxes and how to make sure you're making better decisions in our estimation. And this really applies to everyone. So this is kind of this first section on personal planning. So when we look at tax tip number one, and this is the hardest thing to do, right? Anticipate the future, right? So when you look at your own personal financial situation, whether you're in your 30s, whether you're in your 60s, maybe even in your 80s, and knowing that you're going to have time to plan for your financial future, whether it's 30 years, 40 years, 50 years, is really to look at how do I make good decisions, and specifically, how do I make good decisions that can help lower my tax liability over my lifetime? Now, with that being said, the ultimate goal for many of us is to make more money, which means we pay more tax, right? So that is the goal, to pay more tax. But we also want to be mindful of being smart about it and pay taxes that are owed, utilize deductions as part of the tax code to make sure you're not overpaying. So a big part of what we do here at Vance Wealth is really focusing on this financial planning roadmap and really looking at how do we look at tax decisions over the long term. And where I think we're very different than a lot of tax preparers and tax professionals is that their advice to you is very much hardwired for today. How do I save the most money today? How do I get my clients the biggest tax refund today? Because we've been kind of wired to save taxes at all costs in today's tax year. We like to take a much different approach and say, okay, given the tax landscape that's uncertain, but given the tax landscape and given your financial goals, what are the things that we can do to maybe even out the tax liability? Maybe pay at lower rates, but maybe pay a little bit more this year if it means paying a little bit less next year. So really having a plan in place and anticipating the future, and that's where you basically mesh your financial plan with your tax plan and make sure it's working for you over a long period of time. So there's not really a silver bullet there. It's just trying to anticipate and making good decisions based on the data we have today, knowing that things will change. And that's one of the keys with any sort of planning is you have to adjust to the times. So when you start thinking about anticipating the future, those of you who are clients, I've shared this chart with you. I know it's a little bit noisy, but I do want to spend just a minute looking at this data. So what we've highlighted here, and if you can see the numbers, I'm going to focus on the right-hand side of this, which is the tax code, the tax rates for married filing jointly, and it's looking at two periods of time, 2017 and 2021. 2017, these were the tax rates that were in place prior to the Tax Cuts and Jobs Act of 2017, otherwise known as, let's say, the Trump tax cuts. And if you look on the right-hand side, I've highlighted in this kind of beige color, these tax rate of 25%, 28%, and 33%. Now, I do recognize that most of our clients who are going to be retiring or on the verge of retiring, they're likely going to be making somewhere between $75,000 to $400,000 in retirement. That is generally the type of clients that we're serving, or they're making, and I know that's a big range, but that's what we see. And so we've all been taught that you're going to be in a lower tax bracket when you retire. Now, that might not be the case. So if you look at the current tax rates in 2021, you can see they've created a few new tax brackets. There's a 22% bracket and a 24% bracket. And that 22% bracket goes from $81,000 up to $330,000. So this anticipating the future conversation is really having dialogue around, do I want to save money at 22% or 24% today and then maybe pay more tax at 25 and 28? The short answer for me is no. So if I can pay some taxes today at these lower brackets at the 22 and 24, a lot of times I'm opting for that decision because I don't want to just delay and have an increased tax liability for tomorrow. The other thing is, tax rates could also go up. They could also, they could go back. So let me pause for a second. So one of the reasons why I'm that I actually forgot to mention was that the reason why I'm showing the significance of this 25 and 28 and 33% tax bracket is that when this tax policy was enacted, the legislation was set to sunset, and sunsetting means it reverts back. So as of now, these will expire as of 12/31/2025, right? So we have a few more years, and then in 2026. These tax rates, the 25, 28, and 33, will revert back. And so that's why it's important, because we might have a window here where we can take advantage of some lower tax rates. And that's why this is so significant. And so again, anticipating the future, this is a big theme is, maybe it's okay to pay tax at these rates. Okay, so tip number 2 is, and it's consistent with what we just discussed, consider converting to a Roth IRA. So let me just give you kind of the Roth IRA 101. So when you put money into an IRA or 401k, those are known as pre-tax accounts, right? You put money in, you get a tax deduction. And the beauty of that is you save taxes today. As that money grows and prepares you for retirement, when you take it out, you pay tax. So you get a deduction today, you pay tax later. The Roth IRA is different. So when you put money into a Roth, you do not receive any tax deduction, any tax break when you put the money in. However, the money will grow in the Roth accounts tax-free, and the assets or the withdrawals from a Roth will come out tax-free. So that's really the benefit, is that if you put in $6,000 today and it grows to $50,000, you paid tax on $6,000, and at $50,000, many decades down the road, you don't have to actually pay tax on the distribution. So that's where a Roth can be quite powerful. Now, many of you might be thinking to yourself, well, I'm not eligible to do a Roth IRA because I make too much money. And there are some limitations. If you make in excess as a single filer, I believe it's over 125, 130,000, married filing jointly above 200,000, you are not eligible to fund a Roth IRA. However, you might be able to convert to a Roth IRA. So as of now, there are not restrictions to do a Roth conversion. There are restrictions, or there are income limitations to doing a Roth IRA contribution. So this is something that you might want to look into, is that if you're finding yourself, and I'll go back a screen, in the 22 and 24% bracket, I would likely make the case that you might want to consider doing a conversion, pay tax today at these rates, and then as that money continues to accumulate, and in retirement, that money will come out to you tax-free. So you can see some of the notes down here at the bottom is, you pay tax now, you enjoy tax-free withdrawals in the future, and basically, as long as the Roth has been open for more than 5 years and you're at least 59 and a half, then you'll get the tax-free status on the Roth accounts. So that was tip number 2. And then number 3, harvest investment gains. Now, many people do whatever they can to delay gains. You might, and we usually think about harvesting losses, right? We want to get tax deductions, but there is a concept of harvesting investment gains, right? So if you're finding yourself, and this happened a lot in 2020, not as much this year as people have recovered, but if you're finding yourself in a lower than expected income year, maybe relative to COVID, maybe relative to being newly retired, depending on your life stage, but if you're in some of these lower brackets, especially if you're in the bottom 2 brackets, because if you're in the bottom 2 brackets, you pay 0 capital gains tax if you're in the 10 and 12% bracket. And they actually created their own, its own capital gain structure. But the reason why that's significant is that you actually might want to consider harvesting those gains and pay the tax now, because you're going to be paying potentially at these lower rates, anywhere from 0 to 15%. So the reason why you would consider doing this is you never want to be in a 0% capital gains bracket, because what that basically means is you miss the opportunity. We look at tax returns every year. We review client tax returns annually, and it's really important that we see positive taxable income, or we see income, up to that 12% bracket, which again is coming back to, as a single filer, about 40,000 of taxable income and up to about 81,000 married filing jointly. And there's some nuances to that. So, make sure before you make any of these decisions as you go into year end, make sure it applies to you in terms of harvesting any gains. And then the last bullet point that I have here on the screen is there's another, one of the things is we've had some really healthy gains. The stock markets have done really well over the last 3 years. And if you feel like you need to make a large purchase, help family out, make an investment, maybe just increase your emergency savings, coming off of a few really good years, this might make sense at year end to go ahead and harvest some gains, be comfortable paying the tax, and then diversifying the assets elsewhere. So those are kind of the big 3 when it just comes to like tax principles. But what I do want to dig into, because this is an area that I think is massively misunderstood, and not charitable giving is not done as well as it can be. And for those of you that are charitably inclined, we do find that many people leave money on the table. And the cool thing is, if you're already giving money to charity, you understand the benefit of getting the tax deduction, but also making an impact on a charity, right? You're making an impact a lot of times on your local community. But by doing it, smarter, not just giving cash or writing checks, you can save a lot more in taxes. So we're going to talk about that right now. Okay, the first one is donating appreciated securities instead of giving cash. Okay, so as we go into year end, we know most charitable giving is done in December, just because people are looking for tax write-offs. It's just kind of a habit people have been getting into. But too often I see people writing checks or giving cash in lieu of giving donated securities. I'm going to walk you through an example of why this is so important. And when we talk about appreciated securities, this could be stocks, ETFs, mutual funds, any sort of investment, you can't it's harder to do like a piece of real estate because it's such a large value, but it's a lot more effective to give these appreciated securities than cash. And the main reason is because when you donate appreciated securities, you get rid of capital gains exposure or capital gains tax potential. And when the charity receives those appreciated securities, because of their tax status, they're actually able to receive those and then sell and not have to pay any capital gains tax. Where if you sell, you do have to pay capital gains tax. So again, this is really important. It's a way of avoiding capital gains tax on some of these investments that have appreciated for you. So let me walk through a typical example. So hopefully this makes sense. What I am assuming here is that you're in the highest tax rate. So this example is for higher earners, north of $500,000 of income. But you can see on the left-hand side, we have this idea of the typical way to donate, cash or check. If you make a $10,000 charitable gift, now I'm using 10,000 as a round number. If you give 1,000, you give more, just use this as a benchmark. So at a $10,000 gift, assuming you're roughly the 50% tax rate, which could be the max in California and federal, you save $5,000 of taxes. So you get a 50% tax savings, right? So basically, your tax bill will go down by $5,000. Now, we all know when you give to charity, you still have less money in your pocket. So you're not giving to charity as a means to save taxes. You're giving to charity as a means to help a local charity or any charity for that matter. And one of the byproducts of that is you will have some nice tax savings. And in this example, it's 50%. So that's the cash and check. You take the other approach, you say, well, I'm going to donate an appreciated investment. So let's assume you bought something and you paid $2,000 for it. Now, and I'm going to give you a few names, but these are not recommendations. There's tons of companies that we know have gone up quite a bit. Tesla, Amazon, Apple, Microsoft. I mean, I could probably name 100 companies that over the last 5 years have gone up 5 times, right? And so here's what we're looking at is if you bought something for $2,000 and it's now worth $10,000, right? So that investment has gone up 5 times. And that means you have a gain in your account of $8,000. This is known as an unrealized gain. So until you sell it, it's unrealized. Once you sell it, it becomes realized. So instead of actually selling this and giving this money to charity, what if you just gifted this investment directly? So at the highest rate, you would save about 35% capital gains on the $8,000. You would also receive 50% income tax deduction. Your total savings on appreciated investments would be about 78%, which basically means that your cost to giving to charity cost you 22 cents of yours and 78 cents of the government's money. So this is a way more effective way to give. Now, I have had some pushback where clients have kind of said, well, I don't want to sell my Apple. I don't want to sell my Amazon. I don't want to sell my Tesla. And I totally get that. And I sympathize with that. How do we then implement this for you? Well, what we do is we take the cash that you were giving to charity. We deposit the cash in the account. We purchase whatever you're gifting. Let's say you're purchasing more Apple, you buy it. What that does is you get a new basis, you get a new cost basis because you purchased it with new money. Then you gift to charity those shares of what you had purchased years ago that you paid $2,000 for. So you still own the exact same investment, but you've gotten rid of this tax exposure. So if you have any more questions on this, this is a great something we can talk offline, but this is definitely a strategy too many people are not doing. Sometimes it's just because it's a little bit of a hassle. Most firms will most charities will take these donations directly. A lot of small charities don't have the relationships to do that. So one of the things that we do recommend, especially if you're charitably inclined, is to potentially look at a donor advised fund. So a donor advised fund basically gives you the ability to move a large appreciated security into this fund. When you deposit the money into the fund, so let's say you move $50,000, you get to get the entire tax write-off for that full $50,000 when you make the deposit. And the cool thing about the donor advised fund, which is what I really love, and I have one that I use and give to local charities, is 2 things. Number one, I get the write-off, but I also get to dole the money out and give to charities on my schedule. And when I give the money out of the fund to charities, I actually don't get a write-off then. I get the write-off up front. And so then if I decide this charity is going to get $1,000 per month, I can just set it up on automatic bill where it just basically goes to the charity every month for $1,000. You might have one that's $200. Like you can really, you can really customize this based on your family's giving intentions. And so I really like this. The other word of advice here is if your income is down a little bit this year, but you tend to be charitably inclined, wait on making a donation until next year. So that way you can use it hopefully next year in a higher income year. So donor advised funds are great. We have access to them. You can get access. So if you want more information on these are really good vehicles from a planning perspective, because what you get to do is you get to give the donation when you need the largest write-off, especially for those of you who have income that's a little bit inconsistent, meaning it's not just stable all the time. So you get to control that, but then again, the charities can have a consistent flow of gifts being received from your donor advised fund. Okay, so just kind of the bottom line, as you prepare to make the most of your year-end financial moves, remember to talk with your financial advisor or tax professional to get the most significant benefit before it's too late. And this is the time right now. We're mid-November. Your tax planning really, in our opinion, should get done by mid-December, because you get too late in the year, it's hard to execute on everything. Okay, I know we do have some prospective clients on this, so if any of you would like a complimentary consultation, go ahead and scan this code. You also can go onto our website and to vancewealth.com and book an appointment there. Just as a reminder, because I know some of you might be leaving, because we're going to transition into some of the business planning tax planning idea, business planning related tax planning ideas. Our next webinar is going to be January 18th. We have not set the topic for that, but generally it has been economic and market update, where we just kind of cover our outlook for what's happening in the economy and the markets. So my sense is that will be the same topic, and no December webinar, getting a little bit close to the holidays. So we decided to give ourselves a break and give you guys a little bit of respite. So hopefully this tax strategy, these tax planning tips can be useful for you, for your family. We are, like I mentioned earlier, we are going to post this on YouTube. So feel free to share this. This should be good information. So let me just do a quick little look here before I make my way over to business planning and see if I have any business tax planning, see if I have any questions. Okay, I do not. So while I see that we have quite a few participants, you're not going to hurt my feelings if you don't stick around. This was specifically designed to transition into two big topics, because personal tax planning ideas very different than looking at business tax planning ideas. So for those business owners that are going to stay tuned, we're going to transition over to business owner tax planning. All right. So we're losing a few, which is okay. It's by design. All right. So we're going to get pretty specific here. When you start thinking about a lot of the work of good accountants, especially from the business owner perspective, is to provide, the rules on how to deduct your basic expenses, how to deal with when you buy assets, on how to depreciate them, and whether you're going to accelerate depreciation. Those are all great questions for accountants. I'm not an expert there. What I want to spend a little bit more time on are some of these creative strategies that a lot of business owners can implement, because in most cases, not all, but in most cases, many of you probably on the call are business owners of a small, closely held business where you might be the only owner, or you have, one other owner, or maybe it's your spouse, right? So the beauty of being in that position is you have the most flexibility on making decisions on how it's going to impact your bottom line, because you're the 100% owner. When you start talking about larger businesses where you have multiple owners, it gets a little tricky, right? Because some of these deductions you may not want to utilize for all owners. And so this really is defined to really help what I guess we would call the smaller business owner, solo entrepreneur, really the closely held family business. So let's just kind of dive in. So one thing that we don't have all the changes for small businesses, but this is one that will have an impact. So any of you, and there's a lot of words on here. This was kind of hot off the press. I put this in about an hour ago. So there in the tax code, there is a net investment income tax. And basically this net investment income tax is an additional 3.8% tax on all your income. This is a federal tax. And this was applied to essentially investment income, right? So this could be on interest, this could be on dividends, this could be on bond income, this could be on real estate income, anything passive. So this was not applied, however, to businesses, right? Because if you are a business owner, it's not really investment income, right? This is your business. This is your profit from your business. And so part of the change that looks like, and you see the headline here, it says pass-through business taxes. So pass-through entities, S corporations are pass-throughs. And so it looks like what's probably going to come to fruition here is that businesses, if you're a single filer with more than 400,000 in taxable income, that you're going to have additional 3.8% net investment income tax, and then 500,000 on joint filers. So just be aware of this. So as an example, if you have somebody who is making, and they're above these thresholds, making $300,000 of profit from their business, they're going to pay an additional 3.8% on that 300,000 of profit. So that's a big part of, that's a big probably hit to the business tax community, especially for decent earners. Now, I was having this conversation with a couple of my financial planners in the office, and we discussed, well, with the SALT, the state and local tax deduction coming back, will this offset that? And, for many people it will. So, you kind of get a little here, you give a little back here, but just be aware of this. And this becomes a relevant conversation. I do think we have a couple tax professionals on this call. This becomes a relevant conversation because a big part of planning at year end is around payroll and deciding, okay, should I take more money as a bonus payroll, or do I just take that as distribution as an owner? And with this new 3.8% tax, it's going to challenge probably a little bit of conventional wisdom around what's the best way to go. As far as I can see, and don't hold me to this, is that this is not going to be effective until next year. So we are going to have time to plan. This is not going to be sprung upon us and make us forced to be ready for this decision by year end. So that's generally going to be a good thing, but we'll definitely want to have conversations to see how is this going to impact you, what decisions need to be made around your payroll, around these owner distributions that come out of your pass-through, out of your S Corp entities. Okay. So I do want to just back up for a second, because I do think this is important when we start going into just generally how we look at taxes. I shared that with you on the personal side. Business is a little bit different, but not that much different. So key ideas. Number one, pay yourself a market-based wage. Too often we see business owners are not paying themselves a market-based wage. Now, you can do research to find that market-based wage. You can talk to your accountant and make sure you're doing a percentage of your total income as a wage, but make sure you pay yourself fairly. It's my understanding, I don't have expertise here, is that this is one of the red flags that the IRS could trigger, is that, hey, you're making a decent amount of money, you have a large mortgage, you don't have any W-2 wages, you actually aren't paying yourself a fair wage. And a lot of times people will do that. Sometimes just they don't know the rules. But number two is because they want to avoid payroll tax, and payroll tax we know can be quite expensive. And so that's a big driver of why people want to pay themselves below market-based, below market wage. Number two, focus on being profitable. Too often people get excited, oh, I'm going to spend money at year end to save taxes. And it's like, don't just spend money to avoid taxes. When I have these conversations with clients, it's like, okay, well, you're going to spend money on something, some item, or whether, a lot of times it's a car purchase because you can get a big deduction, but the goal is to be profitable. The goal is to pay taxes. And so by spending money that's unnecessary for the business, that doesn't really help you. You want to be more profitable. So spend wisely. If there's a business reason for it, awesome. That's what I always ask. When clients say, what can I do at year end? I said, well, what does your business need? And it's like, well, we need new equipment. Okay, well, what's that going to do? Well, it's going to help us grow our business in future years. Awesome. Okay, let's go ahead and purchase that. But if it's just for a tax write-off, I'd be a little leery about making those decisions. Be careful, be a little bit more cautious. But again, paying taxes is the goal. It means you are making money, which is why you have a business. Okay, key ideas number three. Be careful about accelerating deductions using Section 179. So you have the ability when you buy, certain equipment for your business, or most equipment for your business, that you can accelerate the depreciation. You can take these write-offs. I'm not an expert here. This is really an accountant question, but what I would advise you on is if you're in the 24% bracket or below, and your business is growing and you expect to be in higher tax brackets later, you might want to spread these expenses out over several years. You may not want to accelerate that. Now, there might be some people shaking their head as, if I don't take these write-offs, I don't have enough cash to run the business. So that's a whole different element, right? If you need these deductions to maintain your cash position to help you grow, then that's something you have to consider. But just don't take the Section 179 just because you can. And that's too often, as people say, this deduction is available to me, I'm going to use it. Think about, would you want to take an expense this year and only save 24% taxes when you know next year you're going to have a better year and you're going to be at 32%? I would rather not get the deduction at 24 and get it at 32. So I'm making 8% on that money, right? So if you had $100,000 of additional expenses that you could use this year, but you're at 24% bracket, you might want to think about it if you can delay it and get the deduction at 32. So again, be careful about those. See bullet point on here. Ask your accountant and your tax professional about these deductions. These are the conversations you should be having. So one of the things we're going to get into a little bit is we're going to talk about some creative strategies. I do want to look at these tax rates again. So those of you who were part of this personal call, I don't need to spend a lot of time, but I do think it's a gift for those of you that are in the 80,000 married filing jointly, 80,000 to 330,000 of taxable income. If you're in that bracket, I do think this is a gift. These are really low rates by historical standards. And I would make sure that you're not accelerating deductions if you're in these rates, because likely, as a government or as a nation, I should say, I think the number is we owe $30 trillion in taxes. So tax rates probably are going to go up. Now, we could get some pause and we might see our politicians spend less money. I don't have a lot of confidence because this has been going on my entire career, which stems back to the late 90s. But my advice to you is really understand what these different brackets might mean for the future and be mindful of this. And again, be okay paying some taxes. So one of the things when we work with business owners and is at a super high level, we do, and this is business owners, this is our individuals, but this is where business owners can really take advantage of this, is kind of these three areas of, okay, if I implement something called the Augusta rule, if I implement payroll optimization for our business, and also look at implementing retirement plan design, what are the things we can do to potentially save some money? And so there's a bunch of, you can see, I'm not going to make you an expert today. There's some complex issues when you start looking at these different strategies. But if you see at the very bottom line, it shows potential annual tax savings if implemented. So usually in the Augusta rule, it's somewhere between $5,000 to $15,000 per year of tax savings, payroll optimization in terms of adding your spouse to payroll, your children if they're working at your business, somewhere between $5,000 to $20,000 of payroll savings, depending on how many kids you have and kind of their roles with the company. And then the third part of that is retirement plan design. Now, you can see the savings in terms of how you build an appropriate retirement plan can save you between $7,500 and even up to $100,000. Now, one of the things I would be careful not to mention is that on this bucket, on the retirement plan design, these savings are more deferral, right? Because when you put money into a 401k, when you put money into an IRA, are you saving that money or are you deferring the taxation on it? Well, I'll answer it for you. You're deferring the taxation on it. So as you look at these effective planning strategies, the Augusta rule strategy, the payroll optimization, those can truly save tax dollars, where retirement plan design can do great things. It can delay tax liability, but it doesn't eliminate it. It just defers it. So if you're in a really high tax bracket, retirement plan design can be good if you're in the highest brackets. If you're in the lower brackets, you might want to opt out. You might want to choose a Roth 401k as an example. So let me just walk through a little bit on kind of, payroll optimization. We're going to go through just a couple high level ideas around things you might want to be considering. Now, we are in November, so some of these strategies might be a little bit too late to implement. And this might have to just be a good roadmap going into next year. This is definitely something you want to check with your tax professional. But payroll optimization. So adding a spouse to payroll. So if you add your spouse to payroll, you potentially can put an additional like $55,000 away in pre-tax retirement if you choose. So that could be a huge benefit if you need that deduction or if you just need more money to go into retirement plans. Adding children to payroll, while they're in junior high, maybe high school and even college. And we all know the value to children, right? Benefits of working at a young age, benefits of understanding the family business. So getting the kids to work can be a really great benefit for a lot of business owners. And for, what are the taxes? You get deductions on your business and personal tax return. And based on my math, for every, depending on how much you pay, how much work your child actually does, you can save about $5,000 per child per year in tax savings. So, again, if you have 2, 3, 4 kids, that could really add up every year. So consider looking at ways to use this payroll optimization to save some taxes. Retirement plan strategy. So we alluded this just a minute ago, but for you and your spouse, add your spouse to payroll, potentially maximum fund profit sharing plans, and then consider a Roth 401k. So I spent a lot of time on being more purposeful about your tax strategies, and that's where Roth 401ks can oftentimes be quite beneficial. So Roth 401k works similar to a Roth IRA, no tax deduction at the beginning, but the money grows tax-free and is withdrawn tax-free if you hit some of those key 59.5, things like that. So the Roth 401k is quite powerful. And the cool thing about a Roth 401k, there are no income limits. So Roth IRA, you do have income limits. If you make too much, you can't fund it. Roth 401k, those limits do not exist. Cool. And the best thing is, between you and your spouse, you can save over $50,000 per year in Roth 401ks if you do this right. And then by adding your children, you have the ability to fund some college expenses, or they can pay kind of their own way because of the work they're doing. And then they also the ability to fund Roth IRA early in life. So I'm going to give you 2 examples of just reminding some of the power of compounding and the benefit of using tax-free accounts. We're going to use one example of you funding the Roth 401k, but then also the next example of you funding a Roth IRA for your kids. So I apologize, this might be a little bit small, but basically what we're looking at here is what I have circled here on the right-hand side shows annual savings. So let's presume you are just going to start maxing out the Roth, which this year is $26,000 for you, $26,000 for your spouse. So you can put in $52,000. So let's say you did that for the next 10 years. That means you'll have put in over $500,000 into Roth accounts. And in the bottom left, it shows future value. And this is assuming an 8% return. So obviously your Roth accounts, you'd be investing on longer term growth engines, and we don't know what the future is going to hold. And we know past performance does not guarantee future results. But if we use 8%, still a little bit below longer term targets, you can see in 20 years grows to 1.6 million, 25 years grows to 2.4 million, and in 30 years, it grows to 3.5 million. So you can see making these decisions early on can create these tax-free buckets that can be, quite impactful on retirement or even on leaving a legacy. And one of the best things, Roth 401ks, as of now, do not require RMDs or required minimum distributions. The next one is showing the benefit is, we have a lot of you that are concerned about their children, their grandchildren. So they really are focused on leaving a legacy. And so by, putting in a tax planning strategy where you add your children to payroll, you get them to work in the business. One of the byproducts of that is you can get money, they can put money into a Roth IRA. So the only way your children can actually invest is if they have earned income, meaning W-2 income. And when I say invest in Roth IRAs. So what I've circled here is, let's presume your 16-year-old max funds their Roth IRA through age 22. So basically, through age 21. So they do this for 6 years. So they put a total of $36,000, utilizing that same 8% appreciation. By the time they are 67, which is 52 years later, we're projecting you'll have about 1.5 million. And that's in Roth accounts. So the story that I was trying to build, some of these creative ideas around some of the payroll optimization, retirement plan design, implementing the Augusta rule to reduce some of your tax savings. This also has some byproducts of helping to increase not only your retirement plan savings, but potentially your children and grandchildren, again, depending on what your goals are for your family. Okay, so I kind of ran through that pretty quickly. Business planning, business tax planning especially, is very unique to the individual. So, if there are things you want to dive in, and discuss with me, schedule time now. Our schedule is really crazy. It always is going into year end. I also saw that there's accountants on this on this webinar today, and we all know by the time we get into mid-December, it's kind of too late. You don't want to rush to make these last minute decisions. So if you feel like you're a little bit behind the ball, this year is kind of already behind us, use some of these ideas, start looking at implementing them in 2022 if you feel like there's just not enough time on the calendar to get this in place for now. So In terms of, just as a reminder, I'm going to check to see if I have any questions. Nope, no questions today. So I must be doing okay, or I'm just motoring through this material. So hopefully you enjoyed this. Our next webinar is January 18th. We are dark in December. Happy holidays. So it'll be January 18th at 4:30, and we will likely be doing our annual economic and market update workshop that I've now done for over 15 years. So looking forward to seeing you all then. Have a great Thanksgiving, enjoy your holidays, and we'll see you after the new year. Thank you very much.